All right, everyone. So today we are here with Nghi Lee with Certain Lending, and Nghi is talking about the different financing strategies, specifically using hard money as an investing tool. So, there's a lot of different ways that you can finance properties as you're doing real estate investing. And in this masterclass, we're going to talk about specifically hard money, although Nghi has a lot of experience and we'll kind of get into that. Just himself as an investor. So yeah, we'll get started here. All right. So Nghi, I'll let you introduce yourself in the next slide, but I just want to tell everyone, I'm always talking about the importance of building your tribe and working with great, amazing people who can help you, be kind of empire builders, really is, help build your portfolio. And so kind of funny thing, Nghi, I think we got to know each other. Well, the first interaction was probably maybe like 2 years ago. And I think we found each other on a forum on Bigger Pockets. And the funny story is, we're both in the Seattle area. And I think at that time you were working in IT and I was just, a investment, savvy real estate agent. And somebody had asked about hard money or something to do with the BRRRR strategy related to hard money. And I think I chimed in, with kind of my experience on that, and then he chimed in with his, and it was really fun. And it was just kind of like, oh, okay, cool. We were just two people kind of adding value to this, forum there. And then, and that was kind of our first interaction. And then we found each other, I think online, maybe in one of the Facebook groups. And it was really cool. We were just kind of talking about, our different experiences, really kind of from an investor's perspective, about using hard money. And then, we just kind of got connected through meetup groups. And then Nghi went to work for Certain Lending. He actually left, your cushy IT job and got into, the real estate side of things. And so what I love about Nghi is that Nghi is someone that leads with value. And, I included this photo here because I think it's such a good example of who you are as a person. Is Nghi is very into the education side of financing. This was actually taken at a group investing trip that we had in Spokane, Washington. And it was so great to have Nghi and the Certain Lending team represented there talking about, different financing strategies related to using hard money and bridge loans. And Nghi, you're just a wealth of knowledge. I think every time you and I talk and communicate, I learn something from you. And so I just love that you always have that kind of teacher mentality, and you're always looking to add value to investors first. So it's just, you've added so much value to our network and our investors and me, myself. So super excited to have you here.
Oh, man. That was a great introduction. That's probably the best introduction I've ever heard.
Oh,
I hope I can meet the expectations set by it. And likewise on my side, I met Jennifer. Again, she said on Bigger Pockets. I saw this post. I'm like, one day I'll get to know this person, and sooner or later, I actually think we first met in person. I went to one of your meetups. I'm like, this is a different meetup than any other ones I've been to in the Seattle area. And then, and here's someone who actually knows how to do presentations and how to put together a PowerPoint. I was actually really impressed because most people in real estate don't have that kind of, background. And I see a lot of it on the IT side, but I don't see that much in the real estate side. So I'm impressed. And then, and obviously I like to align myself with people who I think are good for the industry. And Jennifer, you are definitely one of those. I think, there's people, in real estate where you can talk to them and you can tell them, you can see that it's all about the money or some kind of self-serving purpose. And I think Jennifer is, basically what you said is that you've already kind of accomplished it and you like to travel and now you want other travel buddies. So you want everyone else to retire with you.
Yeah.
So, that's as real as it gets, right?
Yeah. Awesome. Cool. Well, Nghi, let's talk a little bit more about you. Now, you had come to the U.S. How old were you? You have a great backstory there. 6 years old. And then you, like me, you and I are just workhorses. We work all the time, even still. And early on, now you had a couple of jobs at the same time, right? Can you kind of walk us through your, your story kind of as you're getting started in your career here.
Yeah. So, I mean, as I said, my main life, I mean, when I graduated college I graduated with computer science and business, right? So being in consulting, being in engineering made sense. And, I loved that. I loved that career until I found real estate. And then it kind of became like, oh, I can't wait to get out of this so I can do the real thing, which is real estate, right? That's kind of the mentality we get. But I was actually first introduced to, going backwards, I've always, like you mentioned, been a workaholic. I think in college I worked 3 jobs at the same time. I'm both an immigrant and I guess first generation too. And so I'm kind of used to that. But at the same time, I know that I didn't want to continue that forever. The first thing I did when I graduated was I was thinking, what's the best, like, how do I retire comfortably? Right? Fresh out of college, that was my first thought. And then I realizing that most people don't retire well, like 95%, and actually Albert tells me it's probably higher than that, of people don't retire that well. They either are still working, they are depending on someone else, they're dead, or they're just broke and maybe homeless, right? And so how do I become part of that 5% or that 2%, that 1%? And the more I delved into it, the more I realized that, real estate is probably the best way to get there. And so I got started in real estate in 2014 from that, and I got it started out of a kind of an education or seminar, you would say, which there's pros and cons to each one of them. But I think from there, I kind of consumed all the materials within the summer actually, and then I found bigger pockets, and then you can't consume all of their materials. There's just too much. But it's a constant learning from that, and then I started networking locally, and like you said, I mean, it's hard. I mean, when you're working full time, and I was working probably 60 hours a week. Actually, I started real estate right after I went back to school actually to get my master's, because that makes my parents happy. I think if you know enough about the Asian lifestyle, it's like everyone, and so I made my parents happy. I got my master's, and right after I finished my master's and I was still working full time, I was like, I'm done with my schooling. Now I have another 40 hours a week that I'm not using, even though I was still working 60, right? And I'm like, maybe it's time to explore this real estate stuff. And so when I first got started in real estate, I went to about 4 or 5 meetups a week in the evenings. And so my schedule was that 9 to 5 or 8 to 5. And then from 6 to 9, I went to, meetups somewhere between Lakewood and Everett. I was willing to make that drive, and on that drive, I was listening to podcasts, just consistently learning, right? And I got home about 10 or 11. I ate a late dinner, and then catch up on some work. And then at midnight, I started having, because I started this with a partner, and everything I do is with partnerships, by the way. But at midnight, we would start having our company meetings until 2 a.m., and then we kind of repeated that. And so that was fun. I mean, back then you have a lot of energy, right? That was the before kid life, before kids. And so we started doing fix and flips when I first started in real estate, and in the greater Seattle area. And then when I started, so 2017 was when I had my first child, my daughter, and that kind of just changed my mindset. I realized I couldn't continue working like this, right? And so I needed to start building a future with cash flow. And then so we started focusing on rentals, and then I realized it doesn't really cash flow here in Seattle, so I started going out of state for that. And then so I've kind of been continuing that ever since. And so nowadays as I mentioned, we're about 70 doors, 75 doors. This is a little bit outdated. I have about 20 properties now. But I was testing different states to do it in, and again, a lot of this was before I had really met Jennifer and her network. And I would say that if I had to do it all over again, I would start with Jennifer. It just would remove so much of the headaches that I had to go through. So, I mean, I mentioned I've done things in 8 states. I'm pulling that back now because of all the headaches I've had. And now I'm primarily focusing in about just 2 or 3 states, right? And to do all of this, I realized that for me, it's not about, return on investment as much now. It's more about my return on my time. So I find ways to really maximize my time and make sure that I'm more effective. right? A lot of that, it means that I think a lot of that is the reason why I'm in partnerships. I can't scale this fast and do this many things without partners. And my philosophy towards real estate nowadays has always been, I don't want to see it or hear about it. And most of my properties out of state, I've actually never touched or visited at all. But the way I mitigated that was that I realized I'm really bad at a lot of stuff, right? I'm really bad at managing contractors. I'm really bad about talking to tenants and sellers and buyers. So I'm like, I'm okay delegating that as long as I can find someone that I trust. And for me, It's more about the people. It's not about the market. It's really about the people. I don't go into a market unless I have someone on the ground that I can trust.
Absolutely.
Yeah. But kind of my shift to finance was back when I was still active in flips, I've actually borrowed from a couple dozen different hard money lenders, and a few other commercial lenders, and of course conventional lenders. And I had a huge flip project gone wrong where I paid about $280,000 in financing costs alone on that one project. It was a flip that was supposed to take 9 months. It took 2.5 years. And so I vowed never to let that happen again. And so I kind of went on my search. I talked to over 100 different other hard money lenders. And then I started realizing that these guys aren't doing it right. And I don't think it's that hard to do it right? There's not enough transparency. There's not enough honesty. And it's just, I felt like back then I didn't find certain lending, but I felt like I can independently do it a little bit better. And then, of course, certain lending then came out of our lives, and I felt like we had the same strategy. And again, why do it yourself? How are you going to change an industry if by yourself, right? And so that's why I'm certain now. Certain lending is kind of a fintech company, and we'll talk about that a little bit more later. But it's a different approach to lending, and I think it's a more honest and ethical approach.
Well, and I love too that, sometimes the challenge, especially when you're going out of state, is you have to kind of rebuild your team, right? And you have to get all new contacts. And so, we kind of have that similar business model where our goal is to save the investors time and really be able to, kind of give them a wide variety of options for investing, right? So me on the deal side and certain lending on the finance side. And I think that that's where, really you've been able to add so much value to our database and our network, is by having, the ability to do lending in all of these different states. So that's been huge, and having that option of, really when the customers are working with you, they get Nghi, but they can get Nghi in Oklahoma and Tennessee and Arizona and California and all these different states. So it's just so fantastic too that, that you kind of went through this experience, you found real estate, and then you completely shifted your career towards something that you were passionate about. And that's something, it maybe sounds a little airy-fairy of do what you're passionate about and it doesn't ever feel like you're working. But really, I mean, you and I are living that, right? Is we're passionate about investing ourselves for our families and then helping others do it as well. And so, kind of having the ability to teach and share is just really, the cherry on top. So it's so great to share kind of what we've learned through experience.
And I feel like we're pretty lucky too, right? Not everyone gets to do it. And I think you have to put yourself in a position to do it too. Yes. I think for me, it's like, I didn't imagine this is where I would be, 5 years ago. I never got training and I never went to school for hard money or financing, right? But it's kind of like, that there's a path of progress and you continue to go on that path and find opportunities and see where it takes you. I think just being able to adapt in life and seeing and recognizing the opportunities. Absolutely.
Absolutely. So let's dive into to hard money. So we'll kind of start, and I'll kind of turn it over to you, through the next couple of slides. But let's talk about when to use hard money, because for me, that's as I'm talking to investors, it almost sounds like they're thinking, well, shoot, I would only need hard money if I didn't have money, or if I came across a property that was in such bad condition that needed cash. There's kind of this misunderstanding, I think, of hard money. So I think that this is a really good opportunity to kind of talk about when would it make sense to use hard money.
Gotcha. Yeah, and I always tell people, if I can find you a way to avoid hard money, I would. Yeah. If you have a 45-day closing, you have enough for 25% down, and this property isn't in bad shape, and you're a good borrower, then yeah, I would actually, if you go to me for hard money, I would point you to someone else. and say, go to this guy for a conventional loan, right? But in general, I mean, these are the main reasons why someone would go to hard money. And I think the first and foremost is it's a value-added investment. One is that, usually banks won't finance properties that aren't stabilized in some way, right? Either it doesn't have a tenant or renter, or it's just in bad shape, and banks are just not built to, hold bad properties in their books. And hard money also lets you borrow the rehab funds as well, especially if it's a significant rehab, right? Because if you buy something with 25% down or 20% down, and then have to come up with another $100,000 rehab, that's pretty tough on your pocket.
Yeah.
And so that's what's number one, is that it's a property that you need to add value somehow, whether you're adding value by putting in work, or adding value or you need some time to stabilize and get your rents up or whatnot. That's one reason to use hard money. The second main reason is it's a competitive offer. You need to move fast. You need to make sure your offer is more attractive than anyone else offering with a 30 or 45 day closing using bank financing, right? And so hard money can usually move pretty fast. I mean, 2 weeks is pretty common. 1 week is doable if it's a local lender, but usually around that time frame, and it's almost as good as cash, in most places. So a lot of people actually make a cash offer, and I think in different states, that's a different conversation, of whether they call it cash. But to me, it's almost as good as cash, at least here in Seattle, right? So it's as fast as cash. It's almost as guaranteed in cash in some ways. The third reason are really something about you or the property isn't financeable. Like you yourself, a lot of real estate investors, I realize, especially flippers, they don't actually qualify for bank financing. A lot of reasons why is that the bank usually likes people who have a W-2, who have a salary, right? Or people who actually care about their credit, and everyone should, but not everyone's trained that way, right? And so you might need some time to get there, and in the meantime, you can get hard money on it, right? And the next reason, construction. Again, construction is kind of like the whole rehab lending. So lending on land, which is actually pretty tough, but doing construction loans is typically hard money loans. Banks can do it too, but it's so much of a headache to get there with all the bank policies and how they deal with withdrawals and whatnot. So usually people do it to avoid the headaches of going through banks as well, going through hard money. And then the last part, and we might talk about this later, is that there's a way we can do it so we can maximize the burst strategy and get more money out, and lower your rates and whatnot. Hopefully we'll get us some time to go through it.
Yeah, great. So let's talk about LTV and how it affects the down payment.
Yeah, so I see this a lot on, actually I see it almost everywhere, whether in bigger pockets or even locally. Everyone always mentions the word LTV, like this is such a great deal. It's 90% LTV. I'm like, what does that mean? Or is it's 75%, 70% LTV? And I think people just have to realize that there's all these different metrics of LTV. LTV could mean loan to your cost, and cost is on the lender's side is usually the purchase of rehab. It could just mean the purchase, and usually if you're doing a conventional loan, then it usually just means either the lower of the purchase price or the value, whatever the appraisal comes back as, right? And then AIV is, and if you're looking at it from a rehab perspective, what's the as-is value, what's the after repair value, and what's the loan amount compared to those, right? And so the reason why this is important in the lending world is that it determines how much of a loan you get, right? Every lender has a policy on how high they'll go on LTC or LTP, and how high they'll go on loan to value. So typically in hard money, it's somewhere between 65 and 75. There are exceptions. There are some that go up to 80. There are some that go, only go up as high as 60. But for the most part, most lenders are in 65 to 75% LT ARV. So your loan amount can't be higher than that percentage of the ARV. But usually that doesn't determine your down payment. That usually is kind of what caps your down payment. Most lenders they will say, we'll finance 90% of purchase and 100% of rehab, or 80% of both and whatnot. And so it kind of like they start with that loan to cost, and then they use the LTV restraint or LT ARV restraint to see if they need to push down the loan amount a little bit more. And we can go through some examples of those, but basically it's, when you talk to a lender, you have to understand every lender has that metric. Every hard money lender has that metric, especially if you're putting in rehab, because there's always an as-is component, right? And there's always an after component. And it's basically, the better the deal, obviously the better financing you'll get, right? If a deal has thin margins, you're probably going to have to put in a higher down payment. And so don't believe every lender when they say, oh, we can do 90% loan to cost. Well, if your loan is very tight and you only have a 90% cost to ARV, you'll probably need to put in at least like 20% down payment.
Sure. And the variable too on the loan to as is value and loan to after repair value is the appraisal. So how is it, what does that look like on the hard money lending side with the appraisal? So
it depends on the lender. Some lenders only care about the ARV value, right? And they'll say, hey, that's our only constraint. Some lenders care about both, which is you have to understand which one it is, because both of them could affect your down payment, right? So ARV, and so obviously when you go to a lender and you say, hey, these are my numbers. I'm buying for $100,000. I'm putting 50 into it, and I'm selling for $200,000. Lenders are going to verify that, right? And that's good for you as a borrower, because you want someone watching your back on those deals, right? So lenders will, and they usually verify the ARV in one of three ways, I would say. One is that if they're a local lender and they know the area very well, they can typically do just their own comps, their own desktop valuation, right? If it's a more national lender who isn't kind of in the area, or they have some kind of other requirement on the back end when they because they have other investors, then they might either do a BPO, which is a broker's price opinion, which is kind of like an appraisal done by a real estate agent, right? So it's because they're not licensed appraisers, it's usually cheaper. Or they do a full appraisal by a licensed appraiser. And again, this could affect your timeline on how fast it takes to close, right? So it really depends on the lender, and always ask how long it usually takes to close. But with an appraisal, I mean, we know people we have lenders who use an appraisal and can still close in a week. And typically that's done because they have kind of a good relationship with an appraiser. They're not going through a third-party appraisal company, right? And we also know people who take 3 weeks to close, even for hard money, because they use a third-party appraisal company.
Right. Well, the other thing too that the borrowers need to be mindful of is if they are making a like cash offer or waiving the financing contingency because they are using hard money, and the value comes back lower, they need to be prepared for that. And that's something I think that you and I talk about a lot, but that you always look at too is, what does the borrower have for reserves? In case something like that comes up, right? Because they could, if they didn't have the extra money to put down for the down payment, then they either have to get it somewhere or, they would potentially lose their earnest money, right? Of not being able to consummate the sale.
Yeah. And I think we try to, I mean, it's hard to, especially in an area that I'm not familiar with, or lenders in general, to kind of actually do comps for clients. And so we generally do have some kind of third party, verify that. But for me, if someone brings in numbers and I just look at the numbers, I'm like, like every single day I actually have this conversation, even from realtors who should actually know better. But I look at the deal, I'm like, I think this deal's kind of tight. Are you sure you want to take it on? And that's, if you have I would say if you have a good lender, that's what they should say. I mean, their goal shouldn't be to get every loan. Their goal should be to save your butt, and to prevent bad things from happening.
Absolutely. Absolutely. All right. So let's talk about the BRRRR strategy. So tell us about using hard money as it relates to the BRRRR strategy.
Yeah. So this is where we kind of maximize our BRRRR potential, right? The BRRRR is interesting. So the reason why people BRRRR is, it's on the screen there. The traditional way of investing is that you have to put the down payment on everything that you buy, and you can't move as fast because it takes time to rebuild that down payment. Right? And so your down payment kind of becomes like a fixed cost in some ways, and your money gets stuck. And so hard money usually allows you to either put in lower down payment upfront or get your down payment back on the refinance. Or the BRRRR strategy essentially allows that, which means that you can rinse and repeat, right? That's what that last R is for. So you can actually repeat the strategy and move to wealth much quicker than traditional rental investing. I would say that my tip to you if you're doing a BRRRR strategy is, you know that book, Begin with the End in Mind. It's not a book. It's one of the chapters of the book, 7 Habits, right? And so what that means is that you look at the BRRRR, look at the BRRR, and say, hey, what's the end? Well, the end is repeat. So in 7 Habits tells you to begin with the end in mind, right? And so the end on a single family BRRRR is the refinance, right? Yeah. And so for me, this whole thing about why even get a property, why even buy a property, why even get a loan to buy it and actually close on it if you don't have your end strategy figured out? Because the last thing anyone wants to do is get stuck in a high interest, hard money loan, right? And so, but for me, if anyone ever brings me a deal where they're planning to BRRRR it and refinance, I ask them, are you pre-qualified? Do you know for sure that you can get that refinance? Because I don't want you to get in trouble later on, right? So I'll ask for that, or at least maybe even ask to see a pre-approval from the lender. And that's important. You should always talk to a conventional lender before you talk to a hard money lender in the BRRRR strategy, right? And they'll also kind of help you figure out, how you run your numbers on what the takeout financing will look like and whatnot. So you strategize with them first before you strategize with a hard money lender. The other thing I wanted to mention is that hard money lenders, even if you're using them to buy and rent out in the end instead of buying and flipping, they still underwrite it the same. And what I mean by that is that hard money lenders actually don't care about your cash flow. To you, it might be an amazing deal because the cash flows, but hard money lenders still look at 3 main numbers, right? Your purchase, your rehab, and your ARV, and how much margin there is. And that's what they'll lend on. They won't lend on the cash flow, right? Because for them, it's the LTV that keeps them safe. And when I say LTV, I mean all of it. Loan to cost, loan to purchase, loan to asset value, loan to ARV. So keep that in mind, is that you might have a great deal, but to a hard money lender, it might not be a great loan.
Absolutely.
And then the fourth part is that, a lot of BRRRRs, the best BRRRRs are the ones with a lot of margin in them, right? And who else looks at ugly houses with a lot of margins? Flippers. And so it's hard to get a good BRRRR because now you're also probably competing with flippers too. And again, these people are used to moving fast, buying with cash or hard money. And just keep that in mind, is that's why it's kind of hard to find these deals, right? And then the last thing I want to mention is that, if you're using comps, right? If you come from a flipping world, you make this mistake more often than anyone else, is that you're used to flips, you're using comps that are just maximum rehabbed out, replace kitchen, replace bathrooms and everything. And usually for rentals, you don't do those type of rehabs. Yeah. And so just make sure that when you're estimating your ARV, that you're using rental comps and not flips comps. Otherwise, you're going to be way off and have your money stuck in the project.
Absolutely. Well, and I think that's really the biggest. There's 2 kind of big risks with the BRRRR strategy, right? Is one, it could take longer because you're doing a rehab, and anyone that's ever rehabbed properties knows that things can come up and it can take a little bit longer. So your holding costs could be more. But the biggest risk really is on that new appraised value. I've even had my own properties where, I was BRRRRing and I had an appraiser who said, well, you just bought it for this amount. So, and of course, the appraiser's job is to value it based on, that market, not so much what the investor purchased it for. But that's always the risk. And that's one thing that investors need to understand is, yes, this is a fantastic strategy. You've used it, Nghi, I've used it, Nghi, or I've used it. And it works when it works. But know that there is a risk. You have, the acquisition loan with hard money. You've got a rehab that you're trying to get done as quickly as possible. In some cases, you need to rent the property out before you can complete the refinance. So some borrowers do have to show a lease agreement in order to, get that refinance closed. And that's something that people, as you had mentioned, start with the end in mind. That's a question that investors should ask to their conventional or portfolio lender is, do you need to have a lease in order to close the refinance? So that you can kind of allocate all those costs, the additional holding costs, to get that done. Because again, for the hard money lender, that doesn't matter. But the biggest thing is you kind of want to get in and get out quickly if you can, and then hope that ARV comes back. Now, if you have comps, if you've done a good job analyzing the deal to begin with, and using rental comps like you had mentioned, then the ARV, that's mitigated risk, right? There's probably a lower probability that it would come back at a lower appraisal. But certainly, I know that a lot of people don't think about all those things, right? They say, oh, this BRRRR sounds fantastic. That they get into it and then they don't kind of plan for rehabs taking longer. Sometimes they don't realize, oh, shoot, I need to have a lease. And in some cases too, they won't have planned for maybe a slightly lower appraisal. So.
Yeah. And one other thing I would add is that make sure you're working with people who understand the strategy, who are used to working with investors and maybe are investors themselves, because they'll watch your back as well, right? And that's both on the purchase and that's both on the, especially I would say even more so the refinance. Most mortgage lenders are not trained on the investment side. Most mortgage lenders, most conventional lenders are retail home buyers, right? And so they don't know a lot of these strategies, and so they don't know how to advise you or even watch out for you. And so just keep that in mind as well.
Yeah, absolutely. Okay, great stuff here. So let's get into some examples now. I think we've talked a lot about kind of hard money, but I think the examples really kind of help drive this in. So do you want to talk about, this first one here?
Yeah, so this is no hard money at all, right? This is basically the old strategy before the BRRRR strategy came along. And so this is what you would normally do. I gave an example. Maybe you're buying a house for $100,000 and here's all the specs, all the expenses, all the rents and whatnot, all the cash flow. And so you can see your ROI, which is, pretty good on this deal, but you have to stick in a $25,000 down payment. And so if you want to repeat this strategy, you have to keep building that $25,000 payment because it gets stuck in your property, right? So this is basically buy and rent. There's no rate refinance. There's no rehab or anything, right?
Yep.
And so if you go to the next one, now we start incorporating some items. Here you're buying, you're renting, but you're using kind of conventional loans for both. You're buying with a conventional loan, so you still have to put in a down payment. And then when you refinance, that you basically do a kind of a rate and term refinance to pay off that loan. Actually, sorry, there is no refinance here. This is one where you're fixing it up so that you can get a higher rent. So there's value in this. Obviously, the ROI went up a little bit from the last one because you improve the property. Now the property's going to last longer. You have less expenses, and you get a better tenant. So you get higher cash flow, right? But it's still, now you're actually even putting more money into it. You're putting down payment money and rehab money into it. And you're getting a higher ROI because you better get better cash flow, but it's still not the optimum strategy.
Yep.
And so the third way is now we're kind of doing this BRRRR. And so this is actually purchasing with hard money. And you can still do this with, anytime I say hard money, you can probably do this with conventional or private money too, the way structuring it, but it's just, it doesn't move as fast, right? So this is one where you buy with hard money, and it's nice because hard money will finance the rehab. So if you look at it, you put in a little bit less down payment, or maybe the same, and then, but you don't have to actually pay for the rehab out of pocket, at least not at the end, right? And so you basically get a higher loan amount up front, and then when you refinance, that loan amount is the ending loan is higher. And so and that just means that you didn't put that much money in the beginning, and then you just kind of refinance that payoff, right? And so in the end, you put in less money in, and because of that, usually when you put less money into something, you get a higher ROI, right? One quick other thing is that on the other two slides, we didn't even talk about ARV because we didn't have to do a loan based on ARV, right? Mm-hmm. When we start doing the rehab portion, we have to start caring about ARV. We have to consider, okay, does this rehab actually increase the value? It can increase the rent, which is a nice thing, but you also have to think about value as well, because there is another refinance that happens afterwards.
Yep. So in this example, these are all the same property, but it's looking at the same property in 3 different ways. So in this example, you are using hard money, but you're not utilizing the new value, right? Because it's a rate and term refinance just refinances the existing hard money loan. It does not take into account the ARV, right? So, to kind of keep that clear.
Yes and no. It does take into account. I mean, if it was a thin deal, then you wouldn't get all your money back. You would probably need to put in some money to closing. If the ARV was not that far different from your cost, then you probably, well, first off, actually your hard money lender would have let you borrow that in the first place. So I guess it would have been the same.
Yeah, the ARV on the refinance.
Yeah.
The new appraised value on the refinance. Yeah. Great. And then example number 4.
So example number 4 is that people do this a lot, where so you can actually get your money back if you do a cash out refinance. And there's a difference between a cash out refinance and the rate and term refinance we talked about in the previous one. The cash out refinance requires you to wait 6 months, right? And but the nice part is that now you can actually use the new value unconstrained, and they don't really care about your cost, everything you put into it. They will do a loan based on your new value up to 75% of ARV if this is a single family house, right? And so with these numbers, you end up basically getting all of your money back. And when I say all, I mean just the purchase and rehab. You probably had holding costs and other interest that you pay that you didn't get back. But in general, I mean, those are not that big of an amount. But in general, because now you're getting infinite return because you didn't put any money into it at the end of the day, right? And if you think about it, obviously, if you go back through and scroll back through the different 2 examples, your cash flow is actually being lowered. I want to make sure we point that out. Your cash flow is actually lower now than the other 2 scenarios because you are borrowing more money, right? But at the end of the day, if you are getting infinite return, even if you get lower cash flow, you can repeat this infinitely, and just there's no stopping you. So that's why most people like the BRRRR strategy. I mean, this is kind of like you're already approaching the more advanced side of the BRRRR strategy by doing this. But there's more. But wait, there's more. There's a way that we can maximize even something better than the cash out refinance, because cash out refinance has restrictions, right? Most people don't like to wait 6 months, especially the rehabs, like a $10,000 rehab. They're like, now I have to be stuck in hard money for 6 months. That's not doable. That's not, ideal, right? And so the next example kind of highlights that. And so notice that I changed the, go this way. Yeah, so notice that I changed the ARV. And the reason I did this is to illustrate an example. So there's a couple of cool differences with the rate and term refinance over the cash out refinance. One is that it doesn't take 6 months, right? A rate and term refinance you can do anytime. Day after closing, you can do it, assuming you can finish the rehab in a day, right? But the other 2 parts is that it is actually cheaper. So rate and term refinances are actually, it's usually at a lower interest than a cash out refinance. Probably somewhere between 25 to 50 basis points. So, 0.5% to 0.25%. But the other side of it too is that you actually get you get to borrow more from a rate and term refinance. And so your loan to value is actually 80% instead of 75% on a single family house. And so even if your appraisal somehow, maybe it comes back $10,000 less as it does here, you can still get the loan that you're looking for and get money back, right? Now, a rate and term refinance is essentially paying off a loan, right? You're still not getting to pull money out. So there's still some money stuck in here. But at least in this case, you have the option. Like if this was 6 months later and you're trying to do refinance and the AR and your appraisal came back lower, well, now you can do a rate and term refinance instead of cash out, right? And still benefit. So it leaves you with options, especially as long as you plan it up front correctly. But this is a nice part about, I think this strategy is very forgiving, in case something goes wrong. So I think that, let's see, is there another one? Okay, so there's one more. And this is kind of a super advanced strategy that I think most people actually don't know, even a lot of people at Bigger Pockets. I've actually talked to the Bigger Pockets CEO and some of their staff, and they did not know this. They actually didn't think it was real. They thought it was a scam or something because they had never heard of it. So it could be just like a West Coast thing. I'm not sure. But there's a way where you can actually get both benefits of a rate and term refinance and a cash out. Like you can essentially get all your money back or even more by how you structure it up front, right? Knowing that a rate and term refinance is meant to pay off a loan, well, now all you have to do is increase that loan amount up front to get to be paid off, right? And as long as all the ratios, LTV works, that will work as well. And so now you get the higher loan amount, you get the lower rate, you don't have to wait 6 months, and you maximize your LTV.
Yeah. And then just to be clear for people too, so in this case, what Nghi's talking about is having your hard money lender do 100% of the purchase price and the rehab, and then taking a secured deposit, if you will, for an equivalent of whatever their required down payment is. And so in this example, the loan amount would be $120,000, right? So that would be the hard money loan. And you can do the rate and term refinance on that because they're just refinancing that hard money loan. The investor is not taking any additional cash into their pocket. So that keeps that as a rate and term refinance. And provided that you work with a conventional lender that does not have an overlay for using the new appraised value on a rate and term refinance, then that's where it says that rate and term refinance, $120,000, that pays off that existing hard money loan. So the investor in this case gave the hard money lender $24,000 up front. And then when the hard money lender got paid back, then they get the $24,000 back.
And this is why the hard money becomes private money in this sense, right? And there's actually several ways to achieve this. I mean, one is obviously you have a hard money lender that can do this kind of cash deposit, down payment deposit, right? Another way is you could have someone else come in on a second lien for the down payment or more. And as long as the hard money lender allows that, now you have 100% financing as well. Or you have a private money lender that does the whole thing. There are lenders that do 100% financing. Most of it is private. But if you have a really great relationship with your hard money lender and they're open to doing it, that's possible too, right? And so, but I think the main goal is that you have to get that loan amount higher to 100% of your cost, or even more if you want to shoot for even getting cash out at the refinance.
Yeah, absolutely. And this is something, I think this was the actual post on Bigger Pockets that you and I had connected on, that I was talking about, oh, I love the rate and term refinance BRRRRs. And then people had said, well, what, how is that done? But I want to make sure too, that people understand, because you're getting your money back, or, sometimes I think I've almost said, initially before it was called BRRRR, I was calling it the, zero investment rental or something. But I want to make sure that people understand that you have to have reserves in order to do this strategy. So, just because you have a little bit of money and then you're going to be getting it back, you certainly have to have, reserves up front to do this. I mean, this is a little bit more of a risky strategy in some ways. I think the hard money lenders would call this a little bit more risky on their end because they're having this bigger, loan amount. So there's very few hard money lenders that will actually do it. But if you can achieve it as an investor, then obviously you don't have to wait for that 6 month seasoning. That's huge because you're not stuck in hard money for 6 months waiting for that new appraised value. And then you get that lower interest rate. So, this is probably my favorite strategy really, is, doing exactly as Nghi had described here.
Yeah, no, it's mine too.
Cool. All right. So let's talk, so we've talked a lot about, different examples. So let's talk about certain lending and what you guys do in the different loan products that you have. Cause I know, you guys just have a lot of different kind of options for financing. So let's talk a little bit about that.
Yeah. And so, I mean, we can do everything you can see here, which is basically everything. If you think about it, I mean, it's short-term loans, long-term loans, residential properties, commercial properties, construction. And we do it, I think one of the differences with certain lending is that we are a direct lender, but we also have financing partners as well. And so, it's hard to have one lender do everything, right? And so that's why we having partners to help us cover everything. You really only need to go to one place to get all the financing that you need. I would say the only thing we don't do is conventional loans, because everything we do is in commercial world, because there's a lot of different rules when it comes to conventional, and there's enough players in the conventional space that are good at it that we feel like we need to revolutionize that, right? But yeah, I mean, hard money loans, which is what we call bridge loans, because hard money doesn't sound as nice, right? Construction loans, we've talked about that. Permanent financing, that's what we call anything that's kind of long-term rentals or even a refinance or takeout strategy. And you can only do it with stabilized cash flowing properties, right? We can do it on different types of properties. So at the bottom, it shows a single family. Most lenders consider single family to be anything 1 to 4 units, and that also qualifies for conventional, right? Multifamily is 5 and up, and that kind of is also considered commercial as well. But and then there's pure commercial, where you have hotels, office buildings, and just weird stuff, weird properties, mobile home parks, RV parks, and whatnot.
And I think as we're talking about, specifically kind of buy and hold in this session. So for single family homes, that's, you had kind of talked about the LTV, requirement, but it gets a little bit different with multifamily. Can you talk a little bit about what you guys are looking for on the bridge loan for multifamily, and then why would somebody consider a bridge loan for multifamily?
So I think for us, it's kind of the same, but also different, right? We're still looking at purchase, rehab, and ARV for a multifamily property for a bridge loan. A bridge loan is a very short-term loan, right? The only difference is how you get to the ARV. So there's this idea of a commercial valuation, right, where we value things based on income and not comps, because it's very hard to find comps for multifamilies. There's just not of them around, right? Yeah. And so, and why it's important to get a bridge loan, because the bridge strategy works in every different type of asset.
Yeah.
Right. A single family is the most known way, because it also aligns a lot with conventional. But once you get to multifamily commercial, there is no conventional strategy. So now you have to rely on other different type of takeout financing. And it gets pretty complicated in commercial, because in the single family residential conventional space, there's a common law book that everyone plays by, which is basically Fannie Mae and Freddie Mac, right? They set the guidelines. Every single conventional bank has to follow those. So we know the rules, and the bank might add more on top, but we basically know the general set of rules, right? When it comes to commercial, there is no central rule book that everyone follows. Everyone kind of makes up their own rules. So it gets a little bit more complicated, but it can also get easier, because now you just need to find the right one, which takes time, and which is, again, why we're here, because a lot of us already have that experience. But in general, when you're burring, the burr is essentially you take something that's probably not maximized to its value. You add value to it either by renovating or by stabilizing rents and tenants, because in commercial world, that's what increases the value of the property, right? When you're increasing the income or the NOI. And then you refinance at the higher value and hopefully pull your money out. So it's the same strategy. And I think burr was actually more done in the commercial and multifamily world in the beginning than single family. And then it kind of got pushed and say, hey, we can do that here too. But it's the same strategy. I mean, I'm doing right now with mobile home parks. We're buying really bad ones and just adding value to it and then refinancing. It's the other side of it too, is that most of these projects also take longer as well. It takes a lot longer to stabilize an apartment or mobile home park than it does a single family house.
Yeah. Right? Well, the other thing too is the takeout lender on multifamily is going to want several months of stabilized P&Ls. And so I have a lot of investors that have come to us and wanting to do a multifamily BRRRR. And, we're kind of setting that expectation that, some lenders may want 12 to 24 months of a stabilized P&L before they can refinance. So there's a big difference from single family to multifamily, because single family is more just about the comps. If you have the comps and you qualify with your debt to income ratio and your personal qualifications, then you can refinance as soon as you're ready to do so. With the multifamily, even if you've gone in and stabilized the property and maybe you did it really fast and it took a couple of months, the lender's not going to use that new NOI for some time. And as you had said, it's a little there's no black and white answer to that, because everyone's a little different.
Yeah, and the other side too I want to mention is that when it comes to commercial lending, people care a lot more about experience.
Yeah.
Especially your takeout lenders. They want us to know that, it's if you don't know what you're doing, it's very risky, because these are big projects. So it might be a bigger hurdle and barrier to entry to get into commercial than single family. So most people start in the single family space, gain some experience, and they might even want to partner up, because you might want to bring in a partner that has that experience in order to get a loan, right? And so there's different rules at play and different guidelines, and it's fun but also frustrating. And it can be nice too, because what if you're someone who can't get conventional loans? Yeah, it's nice to play by different rules, right? The other thing I want to mention is that you can still, there's a difference between a commercial property and a commercial loan, right? Commercial properties are kind of zoning, but they're classified by five plus units essentially. If anything, 5+ units, or obvious commercial use, like a doctor's office, is commercial, right? In commercial lending, the word commercial just means business purpose loans. Yeah. And so a single family house as a rental is actually considered a business purpose loan. So there are cases where you actually can get a commercial loan on a single family house or a portfolio of houses. So keep that in mind again, is that, and that's another way to get around the whole, if you can't qualify for conventional, there's still other ways we can go about it.
For sure. Great. Perfect. All right. So I want to ask you a couple of frequently asked questions that we get from investors about hard money lending. So what does a hard money lender look for in a borrower, and what might disqualify someone for hard money?
In my experience, primarily hard money lenders care about your experience. It doesn't disqualify you from getting a loan, but it's what sets your pricing for the most part. The more experience you have, the more attractive a borrower you are. And because you know what you're doing, it's less risky to a lender, right? And so they'll give you better pricing for that, because pricing is based on risk essentially, right? Yeah. So experience sets terms for the most part. The second thing they look for is liquidity, which is basically your cash on hand. And it could count things like stocks and retirement accounts, because you could pull money from that, right? Or HELOCs, or even sometimes like life insurance policies with cash value. And so liquidity is important, because flipping or anything with rehab in general, even a BRRRR, is very cash intensive, right? A lot of things go wrong all the time, and having enough cash on hand is really the best way to handle that. So if someone has just enough to do a flip or a BRRRR or rehab, I'd be pretty scared. I probably would tell them to walk away, saying you're pretty tight. Like, you have no room to wiggle, and things will go wrong, right? And I think I had to educate, because some people ask the lender, how much down payment do you require? And the lender says 20%. And they said, great, I have 21%. Yeah. And they think they have just enough, right? And just, if you think about it, down payment is not the same thing as cash to close. Yep. Right? When you actually come to the closing table, you're bringing down payment, you're bringing all the lender fees and all the closing costs, and maybe some like pre things, like you may have to pay interest ahead of for the month, or pay for insurance ahead for the month. So all those things add up, and so it's a lot more than just down payment, right? The second part is the rehab part. If you have a rehab loan, most lenders that give you a rehab loan do it on a reimbursement basis. So they expect you to front some of the money, not all of it, but enough in draws, so that you can get started, and then they reimburse you. And if you have just enough for down payment, you don't have enough to start that rehab. Sure. And so So liquidity is important. The third thing is credit. I think most lenders have some kind of credit consideration, right? It's not like a conventional loan where like you have this credit here, and because you're this credit, it sets the rate. I mean, some hard money lenders do that, but for the most part, hard money lenders just have a minimum credit score that they say it's either a pass or fail, right? And usually it's in the low to mid 600s. But if you have really bad credit below that, there are still some hard money lenders that don't care about credit at all. They just tend to be more expensive, right? Sure. What might disqualify someone for a hard money loan? It's usually, a lot of it is based on the deal, right? If the deal doesn't look good, lender doesn't want to lend on it, and you should probably walk away too. The second thing is the credit report somewhat matters because a lot of lenders are still very antsy about recent bankruptcies and foreclosures. And so, it's just when you show experience of not paying your mortgage, it makes other lenders very, very iffy and scared. And the other thing I can think of is criminal history. If you have a criminal record, most lenders will do a background check, and it's going to be hard to get a loan. Right.
And then the other thing too is you had alluded to it in the last slide. So these are business purpose loans. So obviously, if you're looking to own or occupy a property, you cannot get hard money on that property, even if it's with the intent to live there. So if you want to use a hard money loan to fix the house up and you have the intention to move in, that could disqualify people. Because I get that sometimes.
Thanks for mentioning that. I actually that slipped my mind. That's very important. And people try to hide it, and some lenders will catch it. Obviously your addresses, or it's just there's ways to catch it. Some lenders might even be scared if it's a second home too. Just FYI, because again, it's not business purpose, right?
Yep, absolutely. So does a borrower have to have an LLC, or can you lend to someone in their personal name? And when would it make sense to do one versus the other?
I'm going to start this by always, this is often more of a tax and legal question than it is a financing question. So I always defer to your accountant or attorney, right? But I can tell you that most lenders do prefer an LLC. They don't necessarily require it though. There are some lenders that do require it, and all you have to do is, I would say, find another lender or create an LLC. And then and you can tell that some lenders prefer it because they would charge you a little bit more if you do it in your own name as well. But I think the LLC in general, I mean, for an investor, it's better to have. It's more asset protection, assuming that you are running your business correctly. And to lender, the other reason why lenders like to lend to LLCs is that it becomes it's more obviously a business purpose loan. Yes. Right.
Yeah. Now, the downside to that, though, is if somebody is getting a conventional refinance, then you have to have the refinance in your personal name. So again, this isn't tax or legal advice. We're not qualified to give that kind of advice. But if the hard money lender gets the green light and you close in an LLC, great. But just know that the conventional lender, if they're selling to Fannie and Freddie, if they're a secondary market lender, they are going to want the property to close in your name. So in some cases, investors have closed in an LLC, quitclaimed back to their names personally, and then quitclaim back to the LLC after the fact. Again, we're not, advising people to do that, but know all of the rules of the game when you're, doing these kind of strategies using, this. So in some cases, I've seen other investors, they'll close the hard money loan in their name personally because they know they're going to use that rate and term refinance and doing the 100% loan. And they're going to be pretty quick about it. So, they leave it in their name. And then once, they're done with the conventional refinance, then they implement their own strategy. So FYI, just kind of, again, we're bringing all of these things up so that people can know what to ask the questions of and then to whom. Yeah. So, all right. So what are some common rates, fees, and terms for hard money? And I say common, I know that it's so project dependent, it's, location dependent, but maybe just to kind of clarify for some people, that are maybe kind of wondering what some common rates, terms, and fees are.
It is very, And as you know, like in basic economics, supply and demand drive pricing, right? And so if you're in a big area where there's a lot of hard money lenders, you're probably going to get pretty good pricing. And the pricing I'm going to give you is kind of where our area is, which is the Seattle market, right? And everything around it, right? So in this area, what I've seen is if you're a newer investor, and newer meaning you don't have deals under your belt in your name. That's another thing I want to mention is that some people think because they sell properties, like as a real estate agent, that counts as experience, right? Remember, that's not investor experience, right? Or they do private lending to a lender on a deal, that counts as experience. Nope. Right. You want the investor. You don't have your name on title, and you are not on the hook. So people make different decisions as an investor. So if you are a new investor with limited experience, then you're probably getting around in the Seattle area, either rates start probably around the 9 or 10%. The local lenders still go at 12%, but nowadays it's competitive enough that you can find 9 or 10. Your points will be 2 to 3 around that range. You can probably get a 1 year, somewhere 8 to 12 months out of this, and then you can put 10 to 20% down as a newer investor. Down payment, the more you put down, the probably better terms you get as well, right? So those are new investor terms. The difference when it comes to an experienced investor, and I would say experienced is probably anyone with at least 3 deals under their belt in the past 2 years. They count recent experience. You're probably getting rates in the 7th and 8th, and your points are probably 1 to 2 points per loan.
And that's for a 6 or 12-month loan.
That's usually for a 1-year loan, and you might be able to get 2-year loans too.
Great.
Now, when I was mentioning how price varies per location, I've heard in the Midwest, people are. Well, actually, it's funny. It also depends on the time too, because in Seattle, back in 2010, when there was not that much money available, I think they were charging like 15% and like 4 or 5 points, from what I've heard, right? They're still doing that in some parts of the Midwest, and a lot of that is because the price marks are so low, they have to charge this much to make sense for them. Yeah. I know down in Grays Harbor, there's no competition. No one else lends down there. There's just this one guy, and he lends it out at 10% and 10 points. Wow. 50% down. This was the same guy that actually financed Brandon Turner's first deal, I believe.
Wow.
And so he's still doing business there. And again, there's no competition, so no reason for him to change his pricing, right?
Sure. Yeah. And then the other thing too is typically these loans are interest only. So you pay, if it's 12% interest and you borrow $100,000, it's $1,000 a month. So, all right. So how does financing a flip differ from financing a rental property?
So to a hard money lender, it's not that much different. I want to remind you that, again, hard money lenders don't care about your cash flow, right? So it's always about purchase, rehab, and ARV. And ARV, just make sure you're being careful. Your ARV and rehab costs for the same property is probably different on a rental strategy versus a flip. Yeah. But other than that, hard money lenders will look at it the same way, even if you don't look at it the same way, right, with the cash flow. They want to make sure that there's enough equity for them to lend on the deal, and there isn't, they'll just make you put in a higher down payment.
Yeah. And then, of course, the emphasis on the refinance strategy.
Yeah. Some lenders don't care about how you exit, but the good ones will make sure that your exit strategy actually sounds like a good strategy and doable.
Yeah. So what should a borrower look for in a hard money lender? And is there a difference in working with a local lender versus with a national lender?
So I think for me, it's the ability, so reputation and execution are the biggest things I look for when I look for a lender, right? I think most lenders, they advertise teaser rates and whatnot, and everything is good, but I want to make sure that can they close, and can they close on time? Yeah. Those are the biggest things, because as an investor, it hurts you a lot if you don't close, but most lenders don't actually get hurt if nothing happens, right? They don't lose any money. Yep. And the investor is the other side. And I would say, usually when you're working with a local lender, there is a higher guarantee of closing, and if there isn't, they'll tell you that up front, right? mainly because national lenders will take some more time to do due diligence. So it takes some time for them to give you a final commitment, right? But so national lenders tend to be actually cheaper than local lenders, in my experience. They have cheaper money, and because they have cheaper money, that money comes at a cost in terms of how much headache it'll take to get. So there's kind of these two spectrums, is that you have the really expensive, easy to get money with little qualification, and you have the really cheap money that takes a little bit more effort, both in guidelines and documentation and whatnot. And it's just you kind of have to balance that. And one end used is more of a local lender versus a national lender. I think that a lot of people, like for me, my philosophy is I like to take, as you mentioned before, it's a lot of effort to rebuild something in a new market, right? Rebuilding a team, and I would love to be able to take the team that I have and take them everywhere I go. So I tend to use national lenders because I invest in many different markets, and I can use the same one in all these markets. To me, that there's value in that. But of course, everyone's different, right? And so, but I think when it comes down to it, make sure your lender has a good reputation, and that they can deliver at the terms that they give you, right? A lot of lenders also play this bait and switch game too. And again, one of the reasons why I'm in this, we're in this space, is because there are a lot of unethical lenders out there. And we hope to change that.
Yeah. And I think the other risk too, because I see this a lot on the investor side, is, also kind of knowing how well capitalized your hard money lender is. I had a investor about a week ago, I think it was a Friday evening, had reached out to me because their hard money lender had funded another deal, and they were to close on Tuesday, and they were about $50,000 short. And so he said, the lender that I had lined up, this is again Friday, for a closing on Tuesday, is $50,000 short. Do you have somebody that can, either do the entire loan or cover the $50,000? And he was stressed out. And so that's the other thing too. I think you had mentioned, working with the same team is so valuable. I mean, I will even pay more to work with the same team, to not have to kind of reestablish that trust and the reputation. Because for me, it's not worth the potential stress of going with, someone that I don't know, that has these teaser rates, only to down to the wire not be able to close. Because that's costly. And that could also harm the investor's reputation, right? With whoever found them the deal. If they're having to do all of these extensions, or they're having to get out of a deal, or not close on a deal because whoever they had lined up for financing didn't work out. As an investor, you might not get the next deal, right? Because everyone kind of looks at that, right? And we look at that as investors, and it's the same thing. For the people that are finding us deals, is our ability to execute and close is going to depend on the people that we work with to do that on the lending side. So it is extremely important. And again, it's kind of funny because I've had people say, oh, well, why don't you shop around for, we work with a local bank on, some of our HELOCs. And sure, we're probably paying a little bit of a higher interest rate than we could to a credit union, or, if we went and reestablished a relationship. But the ability to just know with a high probability that we're going to get what we had asked for is invaluable. And so again, I appreciate our relationship, because I know, through our network, and then, through the personal kind of working together on these loans, the probability that certain lending is going to close on these is very high. And you guys have kind of built that reputation. And people can watch the videos on your website too, and kind of hear from others as well, other than just me. So.
And I would say, usually in those cases of not having enough money, I think there are a lot of mom and pop hard money lenders who are actually more like private lenders. That happens more so there versus a big, national lenders, I don't usually see that being a problem. Sure. It's more of a local lender problem usually. Yeah. But local lenders are all of different sizes too, right? There's very big ones, there's very small ones. I recently had a deal where I sent to another hard money lender locally because it needed to close so fast. And there's this is kind of, it's above our, we can't fund it. We don't have enough capacity to fund it. And I was surprised to hear that as well. But
Yeah.
it's not very something you hear very much here in Seattle, right? Because there's such deep pockets here, but I can see that happening in other states.
Yeah. Yeah. Well, again, just more things for investors to be aware of. I think you and I are really good at kind of telling people all the things that they need to look out for. So great. All right. I think that that's the majority of the frequently asked questions. I think we really kind of did a deep dive in a lot of different areas. So for people that want to get in touch with me, they can find the contact information there. Nghi is known to respond to emails at 2-3 a.m. So we're working on that, right, Nghi, of not working at all hours of the day. But it's really easy for people to, if you have a deal and you want to have Certain Lending take a look at it, you can go to certainlending.com. And I've done that before. I mean, I think took like 2 minutes to just put the information on the deal in there. And then, that kind of starts the relationship with Nghi to kind of see what products they have available. And Nghi, you had actually just gave a good example that I was going to bring up is what I found with Nghi and Certain Lending is if they don't have an option, they will find you someone that does. And actually, we've had a couple of clients that Nghi, you found other sources of financing for them. And it's just fantastic to have a resource like you where, we know that either, Certain Lending will do it or we'll have a lender to take care of the investor for that. So,
yeah. I think we definitely take a different approach to lending, right? I think if you go to a single hard money lender, you go and their job is to sell you that their program is the best for all of your needs. And which is not the case. I've never found one lender that can do everything, right? I think for us is that what we do is you come to us, we actually listen to the scenario, and then we cater a loan to it.
Yeah.
Whether it's our product or one of our partners, to actually solve the. And I think that's the best way to solve a problem. And the other side is that we use a lot of technology. I mean, we have half the company is actually software engineers, and they're really smart people. And we're finding new ways to revolutionize just lending in general, right? And so you'll see that when you visit our website, how different it is from most other websites you'll see. And our goal is to save you time, essentially. And so, instead of, I would even encourage you, instead of calling us and emailing us, the first thing you should do is go on the website and put your deal details on there. We have an intake form, essentially. From there, we have the majority of information we need, and then we'll contact you and then run through different scenarios, and we'll have a much more well-informed conversation. Of course, if you still, we're always available by phone or email as well. I think there's some people who are afraid of technology, and we understand that as well. But we try to make life simple in any way that we can.
Yeah, fantastic. And the other thing too, I really appreciate your transparency. So the other thing that actually we didn't really cover is that some lenders, will have the kind of rates and things online. And then when you actually get down to closing, you'll realize that they have all these processing fees and underwriting fees and things like that. But with Certain Lending, my experience has been that you guys have that all up front, is you get all that information right up front, not, when the HUD statement comes out and you're about to sign loan docs. So I really appreciate that.
I think that's really important. Again, I've kind of seen a lot of the tricks out there. And by the way, we didn't mention this, but there's a lot of scams when it comes to lending too. If you just find some random lender, especially if they're offering you rates that just seem too good to be true, this is where it comes back to make sure you research their reputation. And if they're asking you for money up front, just be very wary of it, unless it's with an appraisal, because that's usually valid. But if they're asking you to give them money up front to do a loan, that shouldn't need to happen. That needs to be done with a third party at closing.
Right. Absolutely. Yeah. Great point. Perfect. Well, thank you so much, Nghi. You're a wealth of knowledge. We covered a lot of information here, and I think that this is really going to help a lot of people kind of get a greater understanding of hard money, bridge loans, and what Certain has to offer. So thank you so much.
I had fun, and this is, I think it'll be really helpful for us too. I feel like we should put this on our website as well.
Absolutely. Awesome. Well, thanks, Nghi, and you have a great day, and thank you so much for being here today.
Thanks, Jennifer. Bye, guys.
All right.